For most companies, the objectives associated with fixed assets are fairly simple. The company acquires fixed assets like furniture, machinery, and computers, uses them productively for some time, and then disposes them off. Some fixed assets are used to generate periodic revenue. An appropriate portion of the cost of fixed assets, which is used or has expired in generating revenue, needs to be charged as cost. Such an appropriation of the price of fixed assets is termed depreciation. In simple terms, depreciation is a measure of wearing out, consumption, or other loss in the value of a fixed asset. It may arise due to the use of the assets, passage of time, and obsolescence of the assets through market or technological change. Even though depreciation is a permanent and continuous decrease in the book value of an asset, it is a non-cash expenditure. Depreciation of fixed assets provides companies with the true results of operations and the true cost of production. This, in turn, helps to find the true position in a financial statement. We often use the terms written down value, depletion, and amortization in the process of depreciation. The written down value or book value or unexpired cost of a fixed asset on a particular date is the original cost less depreciation charged on the fixed asset from the date of purchase to that particular date. Depletion in the exhaustion of an asset, generally of natural resources, by deterioration. It applies to wasting assets such as coal mines, quarries, fisheries, etc. Amortization is the depreciation of intangible assets such as patents, copyrights, goodwill, etc. There are two ways of charging depreciation. One, by charging depreciation to the asset account, and two, by maintaining a depreciation or accumulated depreciation account. Let us examine the first, charging depreciation to the asset account. Here, depreciation is directly credited to the respective asset account. Accordingly, the asset appears at a reduced value, that is, the original cost less depreciation till date. In case of the sale of the asset, the value realized is credited to the asset account. If the sales proceeds are greater than the book value on the date of sale, then there is a profit on sale. But if the sale proceeds is less than the book value on the date of sale, there is a loss on sale of asset. When depreciation or accumulated depreciation account is maintained, the amount of depreciation charged in a particular year is credited to the provision for depreciation account and debited to the profit and loss account. Hence, the asset appears in the books at its original cost. When the asset is sold, the provision for depreciation is transferred to the asset account. The amount realized is credited to the asset account and the balance is transferred to the profit or loss account. Let's learn more about depreciation with the help of an example. Suppose People's Transit purchases a truck at the price of Rs 10 lakhs. The truck comes with an additional sales tax of Rs 1 lakh, additional fittings of Rs 40,000, installation charges for a logo, and a GPS at Rs 10,000. These costs cover delivery, installation, and readiness for use. The total cost of the truck would therefore be 11,50,000. The company should consider the following aspects before charging depreciation. 1. The historical cost. which is also known as the purchase cost, original cost, or acquisition cost of the asset. Historical cost includes purchase cost plus capitalized expenses like wages paid for installation of assets, delivery charges, commission, and all other such costs that increase the capacity of the assets. 2. The useful life. Useful life is the period over which a depreciable asset is expected to be used by the enterprise. It is estimated normally based on various factors, including previous experience with similar types of assets. 3. The scrap value or residual value or salvage value. The estimated residual value of a depreciable asset is the value expected to be realized on sale or exchange of the fixed asset upon the expiry of its useful life. And 4. The depreciable amount, which is its historical cost less the estimated residual value. Considering these, People's Transit must calculate the depreciation expense each period based on the following information. Purchase date January 1st, 2012. Cost Rs 11,50,000. The estimated salvage value or residual value Rs 1,50,000. And the estimated useful life or expected useful life 5 years or 100,000 miles. Under the straight line method of depreciation, also known as the fixed installment method or original cost method, the depreciation expense for each period is calculated by dividing the depreciable cost of the asset with its useful life. An equal amount of depreciation is written off every year during the useful life of the asset. The depreciation is charged on the original cost of the asset every year. The cost of the asset reduces to zero or its residual value at the end of its useful life. This method is normally suitable for adopted for assets like furniture, patents, copyrights, trademarks, etc., where repairs and the possibility of obsolescence are less. Alternatively, companies can also adopt any of the following depreciation methods. The reducing balance method, the sum of years of digit method, the annuity method, the sinking fund method, the machine hour method, the production unit method, the depletion method, and the provision for repairs and renewals method. Let's see how depreciation is calculated for each of these methods. Under the reducing balance method or written down value method, a fixed percentage of the diminishing value of the asset is written off each year. Depreciation is calculated with this formula where R is the rate of depreciation, N is the useful life of the asset in years, and S is the scrap value at the end of the useful life of the asset. Depreciation is charged on the written down value every year. The rate of depreciation remains constant, whereas the amount of depreciation goes on decreasing. The value of an asset can never be extinguished or brought to zero as in the straight line method. This method is logical in the sense as the asset grows older, the amount of depreciation also goes on decreasing. This method is suitable for assets like plants and machinery and building, in which the number of repairs and renewals goes on increasing as the assets get older. The annuity method takes into account the interest on the amount invested if the purchase of the asset. It assumes that the amount invested is acquiring the asset, if invested elsewhere, would have earned interest which must be considered as part of the cost of using the asset. The amount required to be written off every year is calculated with the help of an annuity table. The significant advantage of this method is that it takes into account the time value of money and provides for interest on the amount invested. This method is suitable for leases in respect of which a lump sum payment is made in advance. In this method, the amount of depreciation is equal to the original cost of the asset less scrap value into the value of annuity at the given rate of interest plus interest on scrap value, if any, for a year at the given rate of interest. In the sinking fund method, a sinking fund, also known as the depreciation fund, is created for the purpose of accumulating sufficient funds to replace the asset at the end of its useful life. An amount equal to the annual depreciation of the asset is charged against the profits every year and accumulated in the form of depreciation fund. An equivalent amount of cash is withdrawn from the business and invested in securities which are readily convertible into cash. The interest on depreciation fund investments is credited to the depreciation fund account. At the time of replacement of the asset, the investments are realized and the proceeds are used to replace the assets. Hence, this method not only provides for the depreciation on the asset but also makes a provision for replacement of the asset. This method is most suitable for assets like buildings and leasehold lands.